It's Mike Head from Ethical Screening, and I'm talking to David Harrison from Rathbone. If you want to introduce yourself, David.
Thanks, Mike, and it's good to be here. My name is David Harrison. I'm the fund manager of the Rathbone Green Bank Global Sustainability Fund. The fund's been going for 5 years, and I've been at Rathbones for just over 9 years now.
So the topic du jour, greenwashing. What do we say? Do you think it's getting worse, or do you just think it's getting different?
I'd say it's getting different. I think if we go back 5 years or 10 years, you could get away with greenwashing without being called out as much. I think it was that there was some pretty scandalous stuff that went on. I think if you look today, particularly for us, the days of cigarette companies trying to pretend they're green, everyone, I think that even they've perhaps tried to give up, or the kind of the heavy carbon polluting oil companies. But what we do see is that there is a repurposing of businesses that often have a lot of marketing budget, particularly in areas like the consumer space, where they will be very clever in their relationship with the rating agencies, perhaps with MSCI and others, who we do use, but are just one input. And you often see that they have the right message. They can perhaps, let's say, hide or kind of downplay certain parts of their business operation, whilst highlighting a very small part of their business as being completely sustainable. So I'd say that it's the good thing about greenwashing, it's been called out more, but then it is evolving all the time. So on that top level, you see that companies are really choosing to avoid talking about bits that are terrible for the environment. I'd say, the other part of greenwashing that is become a lot more prevalent in the last couple of years is that even if a company can prove its business it is linked to some degree of positive impact, when you meet them, the culture of the business is not right. It's something where, above all, they will push the message around sustainability, but when you meet everyone below the senior management team, it is a weak culture. It doesn't run through the business. So I'd say, again, it just goes back to, you need that rigor around interviewing companies, having a real deep dive to be able to spot what is really an evolving trend in the industry.
It's right. I mean, it is anecdotal, and please don't sue me. But I met somebody last summer who worked for Exxon, and he said that they spent more money on burnishing their reputation than they did on sort of marketing to make themselves look better than they do on renewables and alternatives. And it's that thing of thinking, it's not really greenwashing, but it's trying to make yourself look like what you're not.
Yeah, absolutely. And I think I think that could apply almost for almost every oil major, whether it be Exxon or I would argue kind of Shell or BP over here. It's that if you look at the economics of what they're investing in clean energy, it's tiny compared to what they're spending on their kind of their green credentials in marketing. I think that issue really needs to be called out. And within our fund, we don't, we've got very clear ethical constraints. We won't invest there. And really, the way we think about it is, to use that example of the oil major, the Exxon, we know there is a critical need to transition away from carbon sources, and as well as the obvious areas of investing in renewable energy, we need to find businesses that are actually transitioning the energy piece, and are helping the businesses like Exxon to decarbonize, but never really to fall for when you meet the management team, asking the hard questions around how much of your capital spending, your budget, is based around decarbonisation, because it comes out very quickly in reality if they are true about what they say and a kind of a very much sustainable business at their core.
It's interesting as well when you think that, because the FCA with greenwashing is looking specifically around labels and at retail funds. But it'd be interesting if they turned their focus onto companies, wouldn't it? Because it's sort of, there'll be an overlap with the Advertising Standards Agency, but fundamentally what they're saying is, you're doing this for financial reasons. Yes, there's a bit of reputational management in there, but it is because you want to continue to attract capital. So that would, yeah, that might, even for the FCA, that might be a bit much to take on.
I think it needs to happen though. I think, you know, if you look at how the whole industry has evolved in quite a short period of time, I would argue, in terms of, you know, really growing, and particularly in places like the US, where now everyone's focused on their ESG rating. I think, you know, there needs to be a kind of a step back and say, okay, what are the standards around the ratings? What's the commonality? Yeah, and how transparent are they really? Because to your point, I think until we get to that point, consumers can rightly be skeptical, because, you know, if you look at, there were tobacco companies that have the highest possible rating from a ESG rating perspective, but then there's companies that are leaders in circular economy solutions that get a low rating. So something doesn't feel that it's completely right, and I would argue, I think we're probably a few years away from that being fixed, and it needs to happen. And I think over time it will get there, but it will take time.
I think as well. I mean, that's a manifestation of scale, isn't it? Because the big companies who have got enough people that know how to fill in the forms to make sure that their MSCI score is as good as possible. If you're a small biotech company making some sort of specialist widget that's going to deal with your diabetes, you don't have the team, so your score looks worse than a company that makes cigarettes. And it's like, there's something not quite aligned here.
I absolutely, and we see that a lot, and that's generally about 20% of our fund is in the kind of small and mid cap space, and we often find you go and meet these businesses that, you know, there's always one of the examples I talk about, a business called Badger Meter, which is not very well known outside the US, but they're kind of leaders in what they do, and for years they didn't spend much money on working with the ESG kind of ratings or the sustainability report, and they'd get marked down. Yet when you go and see the factory or the management team, it's a phenomenal sustainable solution. So you're absolutely right, Mike. I think there is that size bias. I would hope over time that gets removed. Perhaps even, as the technology evolves, I think as we move to kind of a global standard of disclosure as well, that'd be very, very helpful. But again, I think that's the kind of the importance of really interrogating the data, so that it's not the large company with the big budget and the glossy marketing campaign that will kind of win out versus the real sustainability solution providers that might be much smaller.
On the labels front, I'm sure you're doing what everyone else is doing. We'll wait and see, because we don't know and they haven't published it. Which label would you like the fund to have?
So we are, as an entity, kind of a wait and see mode. I believe very strongly that our fund will be kind of sustainable focus. We looked at whether we are. I feel we're never going to be a pure impact fund, because of our focus on financial returns as well. But sustainable focus is very much where we sit. The good thing is that through the relationship with Green Bank and the vast amount of internal sustainability data that we have, we can provide all that transparency. And we know, for example, 80%, in our view, 80% of all the companies we hold have a clear sustainability activity linked, to their core business. So, we also, close to 70% of the fund already it's got science-based targets embedded. So I think these things are always slightly moving, but when we look at our metrics, we firmly believe that puts us in the sustainability focus bucket.
And the last one, so you've been doing it, just you all on your own, been looking after this fund. So okay, how much have you got in there? What did you think it would be when you started, and how's it changed in 5 years? Thank you very much for the inflation and the Ukraine incursion. And where would you like the next 5 to go, apart from away from where we are at the moment and back to sustainability being the focus?
So when we started 5 years ago, we started literally with nothing. So on day one, in terms of assets, we went from nothing. We got that at the end of 2021 to just over 100 million. So we saw a nice growth quite quickly in assets. That's come back now. So we are at just under 70 million. I think something you mentioned, Mike, already. Last year was a very interesting year. We are by nature and how we invest, we're kind of quality growth and clearly investing in long duration themes and assets. So I think we saw some of the money flow out last year. But personally, I would say that might be a good thing, not just for us, but the whole sustainability industry. We had incredibly strong performance in a year like 2020. And whilst I was at pains to try and explain to people that we won't be able to repeat that, I think really the realization that sustainability, yes, the performance has been nice, as a theme in the long run. There will be years where it just doesn't work, particularly when we have a very strict ethical framework. There's a lot of the market we don't invest in, and we have a high bar when we think about the positive alignment of companies. So where we are today, 5 years, say we're just under 70 million in terms of assets. I would say, where would I like it to go from here? I think you highlighted a couple of things already. We've had a lot. We've had clearly, COVID. We've had Ukraine. We've had inflation. The first half of this year feels like we're starting to get back to more of a normal investing environment, and particularly for our style of investing, I would say that has been helpful in terms of performance as well. Looking 5 years ahead, the one thing I think is really interesting, I wrote down the 5 most interesting themes I think for going forward, and they're quite similar to the 5 themes that were there when we launched the fund. So when you think about the obvious ones, energy transition, it's perhaps been called something slightly different now, but it's that was, we knew that was there 5 years ago, but a lot of the underlying has changed. That renewable penetration has gone up a lot. Where we see the big opportunity is within owning clean energy, but also those companies that will actually transition away, help companies transition energy assets. Then thinking kind of the next level about how you manage the grid, energy storage. So that's a really powerful one where we've still got good exposure. I think the one that you have spoken to many people about is water. Water from day one was a very powerful theme. It remains so. Although I would say that trying to find companies to invest in from a water point of view is getting harder and harder. We've had a couple of our companies that have been bought out. I think people recognize the scarcity of companies in that space. So that's 2, and maybe just kind of time-wise, one that I think is slightly different, but I think is very, very powerful, and I've been felt very strongly on, is the industrial digitization trend. And obviously AI and all these things are the word of the day. But it's interesting, everything we've gone through with COVID and supply chains, companies really see it now as non-negotiable, as spending on digital infrastructure in their businesses. And when it comes to the real sustainability focused companies that can do that, they are some of the most interesting. Some of them are not the best known, but the ones that we've held for a long time. But I think as a trend, as supply chains move around the world, they get close to home. Companies that have to focus on resource use better, quicker time to market, I believe that is another very powerful trend. So that's kind of three, I think, that have been very, very consistent. And if I look, further down the line, if we're having this conversation again in 5 years, I believe each of those areas we would have progressed a lot, which I think is sometimes when you got your head down and doing this, almost we forget the progress we've had of things like renewables and the penetration rates, and we're not going fast enough, but that is encouraging. But I think we'd have this conversation again, we'd be further encouraged, and probably see a bigger opportunity set in 5 years' time again. But clearly, I really like the fund. We've grown much bigger than where we are today again. But the first 5 years certainly has been, it's been a very interesting journey, but very enjoyable as well.
I mean, having read the thing yesterday about Toyota and their solid state battery that you can charge in 10 minutes that will do 750 miles. Can I have one of those, please? So I don't get range anxiety and think, oh, where's my extension lead?
I absolutely, and you think about kind of the solid state battery. I remember 3 or 4 years ago, people were talking about solid state, or even an EV that would do 300 miles as being almost unattainable. And it just shows that when there's a will, there's investment, and really the big pivot from the auto industry a couple of years ago, these things can come around much quicker than you think. So again, I'm often been told I'm an optimist, but I think particularly around innovation curves, and particularly we see what we saw in renewable energy now being adopted in vehicle technology. It does make it exciting, and I think we could get there a lot quicker than people realise.
Good. Thank you very much. That was good.
Thanks very much, Mike.
It's a wrap.